Hello and welcome back to Invest for the Future. My name is John Palmer. Today's video will be a tutorial on how to scan the WestPac broking database for companies with high earnings per share growth and high levels of cash compared to debt. And we all know why we should be doing this. Historical data shows that these types of companies are more likely to outperform the market than companies with poor fundamentals. Because I use a paid subscription service called Stock Doctor to access the fundamental data that I need for my scans, I've never really tried to use WestPac as often as perhaps I should. The Stock Doctor scanning tool is not perfect, but it's the closest that I've found to being perfect for what I do. The service comes with a whole lot of other bells and whistles, including a charting package, portfolio optimizer, analyst comments, corporate calendar, but most importantly for me, fundamental data that goes back to 1993. I rate it highly, but it does come at a cost of $1,795 per year, with some discounts if you subscribe for more than 1 year. If you only want fundamental data on an annual basis going back 10 years, then WestPac does a very good job, as does ComSec and probably NAB and ANZ Broking, but I have not used their sites. But thanks to Andy, who posted, wondering if you could share which stock screener you use. Doesn't look like the one you used before on WestPac. I decided to dig a little deeper into the possibilities that WestPac offers. Now before I begin, let me make a couple of comments about this video. Firstly, any of the stocks mentioned in this video are not recommendations from me to either buy or sell, because I do not have a financial services license and the information is really more educational than investment advice. Secondly, the video is a tutorial on how to use the WestPac Scanning Tool, and so you will need to commit 25 to 30 minutes to watching it. The actual desktop tutorial section will run for just over 20 minutes. If you happen to have a WestPac broking account, then I recommend logging into that account and following along as I go through the process. It may be worthwhile to pause the video or replay sections to ensure that you're getting the same results on your screen. What I do ask though is that you support me by hitting the like button and subscribe if you're not already a follower of the channel. So over to the desktop and let's begin. So here we are on the WestPac home page, WestPac Broking, and we're going to go to the tab Quotes and Research, and we're going to be doing a company search. We've been through this several times on the channel, and I think Matt over at the Millennial Investor went through this also just recently, showing you how he's going to be setting up his longer term portfolio. But anyway, that's okay, we'll move on. We're going to go to select category, and we're first of all going to look for the market cap bigger than 200 million. So we're going to go to company statistics, select the field, which is market cap, and we're going to make it greater than 200 million. Now you can make that figure whatever you like. If you're happy to go down to smaller size companies, then you could put 100 million in. If you're only interested in companies that have obviously been doing very well, or larger companies, then you might put in say 500 million. That's a choice for you to make. I like 200 million, so we're just putting that in because that's my preference. Next thing we need to get is the net profit before abnormals. So we're going to come into the profit and loss section. From that field, select net profit before abnormals, and we actually need this to be greater than 0 because we are not interested in putting our money into companies that don't make a profit. So we'll add that criteria. Next, one of the key filters that we're using, of course, is the earnings per share growth is going to be greater than 20%. We need to go to growth, hit the growth tab, find earnings per share growth for 1 year. We need that to be greater than decimal 2, which is the decimal equivalent of 20%. Add that criteria. Now, unfortunately, WestPac does not have the net debt to equity figure easily accessible, and we actually have to do some calculations to get that figure. Firstly, we need to find out what's the cash position of the company. So we go to the balance sheet, select the cash, and you notice that it says industrials. And so what this is going to do is mean there's going to be quite a number of companies that we will not get data for, namely many of them are going to be in the financial space. That's okay, there are plenty of opportunities on the market, and the fact that we might be missing some opportunities isn't going to matter if we can get some really excellent results from the companies that we find. So the cash, we just need to see what that is, so we'll just delete that just in case it messes up, and we'll add that criteria. Next we need to know the total debt. That also comes from the balance sheet, so that's down here, total debt, display only, add that criteria. And then lastly we need to get the return on equity figure, because we need to do some calculations using it. Now the return on equity figure comes under performance measures. Select that one, return on equity, which is living up there, and display only also, add that criteria. So they are the 6 filters that we're going to apply to the WestPac database. They sit there. If you've made an error you can go in and edit them. So for example, if you wanted to change the earnings per share growth to greater than 30%, then you'd click on that and then hit edit, and it will come up and give you a chance to change that figure there if you wish to. We'll just leave it as it is, update the criteria, and it stays there as it was. So we'll search that and we should come up with about 150 results, I think. Yes, 152 results. So that's very good. We've taken 2,000 odd stocks and we've reduced it down to only 152 likely candidates. Now we can actually grab all this in one copy and paste. So we'll display all of those results. Then we'll highlight everything. We'll start here at ASX code and come down with the mouse, just highlighting all of those companies and the data that sits behind them. There we go. So Control C to copy that. Then we're going to come over to Excel. And I've already got this set up with some other information I'll talk about in a minute. And then I'm going to paste that into this particular spot here. Paste that option in there, and there we are. We're ready to go and have a bit of a look at this. Now you'll notice here that this has come in with the name of the company, and it's occupying up a lot of space. So we could do a couple of things. Well, I'm just going to basically, because I'm not interested in what the company is, I'm just going to delete that. So I'll delete that sheet column, and then everything comes back into a nice size for us to work with. So here we are. We've now got ourselves with all of our data in here, and you'll notice that quite a number of these companies have no cash or total debt numbers. And the reason for that is that most of these are, if not all of them, are basically financial type companies. MGR, Mirvac, that's a property trust. They treat that as the way they account for that as a sort of a financial company. If we come down here to PNI, Pinnacle Investments, and so on. It doesn't matter anyway. What we're doing is we're looking for a group of stocks, we don't need lots, that are going to hopefully give us some awesome performance. So what we're going to do is highlight all of these, and then we're going to filter on that. So highlighting all, and we're going to sort it, custom sort it on column D, say, because we want to get these things down to the bottom. So I'm going to sort on column D. Cell values, we're going to go from smallest to largest, and if we do that, then all of the ones that don't have any information in them get sent down to the bottom of the spreadsheet. So we're not in the slightest bit interested in any of these, so we'll just highlight all of them and then delete them. Some of these numbers here are a bit big, so we could just spread that out a little bit. Okay, going back up to the top. Now we need to do some calculation. if you don't like the fact that all these numbers are sitting over on the right hand side of the columns, then you could hit that and hit it again, and then we've now got them in the middle. Just looks a little bit neater. So we need to do some calculations. We need to first of all work out what the equity on this company is. EQUITY, equity. Let's put that in as bold. That'll do. Okay, so to get the equity, what we need to do is we need to get the net profit and then divide it by the return on equity. So we need a formula, so we enter equals, click on C2, which will be the net profit before abnormals, and then divide by F2, enter, and we now have the equity for select harvest. We're going to fill that down, so make sure the box is highlighted, come over, get the black cross, left click your mouse, drag it down, and that will fill all of those numbers in down there. Notice that BHP has $75 billion worth of equity in the business. Coming back up to the top again, now we need to calculate the net debt to equity. So this calculation is equals for a formula, bracket. Now we're going to find the difference between the debt and the cash, and we're going to do it as debt subtract cash, in bracket, and all of that figure is then divided by the equity which we've just calculated. Enter that. And so because I've got this thing set up as being a percentage, it's telling me it's 18.8%. Make sure that box is highlighted, grab the hard cross, fill down, and there we have all of the net debt to equities for all of those companies that have earnings per share greater than 20%. Earnings per share growth, that is, greater than 20%. So if you look down here, these are all these figures that came out of the WestPac database. Now what we need to do, because we know that all of these companies have earnings per share growth greater than 20%, is sort them on the net debt to equity. So we're going to highlight all of these and sort. We're going to custom sort them by column I, and because we want to have the negative ones at the top, we're going smallest to largest. Okay, and so there we have our list of companies according to WestPac that 12 months ago had very, very good earnings per share growth and very, very negative net debt to equity. Now the big question is this the same list as what we produced from my subscription service? So what we have over here are the results from my work on the subscription service that I posted about a week ago. And these were the 23 companies that had earnings per share growth greater than 20% and net debt to equity less than negative 20%. And that was their share price growth over that 12-month period. And if we're looking for what did that entire group of 23 produce, we could hit equals average of their share price growth and produce 75% return. Now the question is, do these companies appear over here? In other words, has WestPac found the same companies that Stock Doctor has found? Let's get rid of all the companies that have got net debt to equity greater than negative 20. So that's all of those there. So we'll get rid of those. And so we're interested in these companies here, and we see that WestPac has come out with a number of extra stocks that Stock Doctor didn't find. Now the question is, are all of these over here? In other words, did WestPac find these? Well, the way to find out is we'll highlight that column, and then we'll highlight this column, then come to conditional formatting, highlight duplicate values. We'll leave them in red if you like, and yes, they did, with the exception of EML. So Stock Doctor found this company EML, which grew by 125% during the year, but WestPac did not. But WestPac did find the others. Let's just reorder these and put the coloured ones up at the top. There we go. Now, if I was to just go and eliminate that one temporarily, so I'm just going to delete that. So we've got them all matched up. Shift the cells up. Cool. Now we've got these companies all lined up here. So here's WestPac. There's Stock Doctor. Stock Doctor says the earnings per share growth was 106%, and so does WestPac. And 28, 28, 313, 313. If you come down and check here, you'll notice that WestPac is giving exactly the same figures. There's one that's a bit different. What's going on there? A couple there that were a bit out of whack. RMS 72.8 at WestPac, but 112 over at Stock Doctor. 24.5, that one's a bit different, that's a bit different, that's the same, pretty much the same, close, a little bit different. So not exactly the same figures, but near enough. Certainly they both found them. If we look at the net debt to equity, negative 61, negative 34, negative 36, just quickly looking down, these are so close to each other, from negative 55 going down, wow, they're all exactly the same, give or take a decimal place. So there you go. This process using WestPac taken us a little bit of time, but we have been able to find exactly the same group of stocks that probably takes only a couple of minutes over in Stock Doctor, but maybe 15-20 minutes of your time and you can find these stocks. Now, as I said, you've also got these extra ones along here, and the question is, why has this produced some extra companies that this one over here did not? So if we have a look at one or two of them, say, let's go and have a look at, say, CCX. So if we come over here to WestPac, this time we're going to go to quotes and company research, CCX, see if we can find out why that's in the WestPac scan but not in the Stock Doctor scan. Financials, see if we can find out what's going on here. Well, there's the reason why. A year ago the earnings for CCX was negative, and Stock Doctor will not calculate an earnings growth if either of these figures here are negative. So that's the reason why CCX doesn't show up at Stock Doctor, but WestPac says, well, wow, look at this, minus 2.5 up to 8.8. That means it's got earnings growth, and so therefore it somehow calculates with its algorithm the earnings per share growth. If we come back and have a look at another one, see if we can find out why. EOS, I think that's electro-optic systems or something or other. Seem to, yep, there it is. Well, same reason, earnings negative there and then positive. So I guess you have to decide whether you want to put them in to your investment universe. Certainly got massive earnings growth, hasn't it? So I suppose it's okay. Got no idea what its share price has done in the last 12 months. Could have a look at a chart, I suppose, and find out. Oh, well, there you go. It's gone from $2.50 odd, $2.75 up to around $4. Well, that was good, wasn't it? So that was an okay stock. Let's have a look at what this one's done. AD8. AD8. Does that do any good? Well, my goodness. It's gone from $4 up to $7. Certainly would have not have complained about having that in your portfolio. Let's try Cooper Energy, COE. Has it done any good? Well, it's okay, it's positive. What have we got? From 45 up to nearly 60, so that's okay. This is looking good, isn't it? That being said though, but some of these companies, COE, Cooper Energy, if we have a look at that one, well, there's another reason. See, it's That's why Stock Doctor hasn't found this thing, because it had negative earnings in the previous period before it's got positive earnings, and Westpac has found it. So we won't keep going on forever here. This is looking pretty awesome, isn't it? Many of these seem to have done very well, and Westpac's actually found them. PNR, I wonder what that is. Pantoro Limited, never heard of them. Wow, very small share price. Went down 5% today. That doesn't look good, does it? There you go. There's the reason why it didn't get found by Stock Doctor. Negative earnings followed by positive. Should we look at the chart? Do we dare? Well, there's one where we've just done not very well at all. So it's not perfect. 29 cents down to 18 cents. So there's a 33% loss on that particular stock. But nonetheless, going back to the spreadsheet, there we have it. Westpac has pretty much found nearly every one that Stock Doctor found, and what's more, it's found a few more, and you need to decide whether you want to include them in your investment universe. Anyway, I hope you've found the instructions there clear enough for you, and that I've gone through slowly enough. Certainly, before I started this process, I wasn't confident that I'd be able to actually access this sort of information out of Westpac, but just with a little bit of tinkering around with some maths and using Excel, you can actually get at it. Just need to spend a bit of time thinking your way through it, and the data might be there. So this is interesting. I thinking whether my $1,700 or $1,800 a year subscription to Stock Doctor is necessary. I guess the thing that you need to be aware of is that in Westpac the data only appears once a year. They only publish the annual reports, whereas Stock Doctor publish the 6-monthly reports as well. And so therefore, if things are starting to go a little bit pear-shaped for a company, there's a chance that you will find that with Stock Doctor, and you won't find that with Westpac, without actually having to go and manually look at the actual reports that the companies have put out. Pretty excited by that. Really happy that we've been able to use Westpac, a free service, to be able to get to this data that's generating stocks that in the last year have produced a return greater than 50%. Now, if you're time poor, then using Stock Doctor for these types of scans is very good. But as I said, it does come at a financial cost, and you may not be willing to pay for that. Using free sites can be a viable option, but it is highly likely that there will be some limitations to what you will be able to do there. In the case of Westpac, some of those limitations are as follows. The data is only updated on an annual basis, so interim analysis will not be possible. You will not be able to save any of your filters that you construct, and you will need to input the constraints each time you want to run any of these filters. You will not be able to save or easily export your results. You will need to manually copy and paste those results into a spreadsheet for analysis. You will only be able to filter on the most recent data or ratios calculated from that data. And lastly, you won't know the date when the latest data was reported without manually going back to the fundamental data for each company. Regardless of these obstacles, if you're looking to produce a portfolio that you can set and forget for 12 months, then that will be possible with a couple of hours of research. Now, I've produced this video using the data from the June 2018 annual reports, with earnings per share growth set at greater than 20% and net debt to equity set at less than negative 20%. Different settings may produce better results, and if you think that this approach has some merit, then I really do encourage you to investigate further. That's certainly what I am and will be doing. I'm partway through analysing data from 2 and 3 years ago, and the results so far are as promising as those presented in this video. So let's bring this together. If you take some time, you can get quality fundamental information at no cost from your Westpac database. Earnings per share growth and excesses of cash over debt point us towards some possibly awesome investments. So, filled with ever-increasing optimism, I'm going back to my research and I look forward to seeing you in the next video. Until then, as always, I hope you all keep very well.